Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Matt Peron, director of research at Janus Henderson Investors, to discuss the resiliency of dividends through COVID-19 pandemic. Matt, it's great to meet with you. Welcome to Trade Talks.
Thanks for having me, Jill.
And Matt, how did COVID-19 affect U.S. dividends and which sectors were most impacted?
Well, U.S. dividends actually fared amongst the best when you look at it versus the rest of the world. So globally, we saw dividends cut significantly, but in the U.S., dividends were flat to slightly up when you include special dividends, up maybe 2% year on year. So it was a good story when you look at it just from a dividend perspective. However, to be fair, the U.S. uses buybacks quite a bit. So when you look at it at a total shareholder return basis, the story isn't quite as positive. U.S. Buybacks were cut first, and that's really what they're there for. Managements use them as a mechanism to cushion any blow, and so they went to that lever, so to speak, and cut buybacks fairly significantly in 2020, just so they could preserve dividends. So that's how it played out for the U.S.
And Matt, you mentioned that global dividends fared worse than the U.S. Was it worse than Janus Henderson's forecast and running better? And why do you think they performed worse than the U.S.?
So global dividends were down about 12% in 2020. And we thought it would be down as much as 17% at one point. It looked like it was going to be more severe. But thanks to a very strong fourth quarter globally, have higher payouts. They use dividends really as their primary way of returning capital to shareholders. They don't have that dividend lever that I spoke of earlier as much as the U.S. They have it to some extent, but not as much. So, and they were also impacted just by the severity of lockdowns were harder, and also a level of conservatism was applied. So globally, the story was quite worse, again, looking through the dividend lens.
And what's your outlook for the remainder of the year? And do you expect a varied response like we saw in 2020?
Yeah, I think so. We think that global dividends will be slow to recover, mostly because of conservatism, a slower pace potentially of releasing, restarting the economy. So it'll be back and half loaded in particular. But and so the countries that were affected worse, let's say in Europe, in the banking sector, they'll start resuming their dividends, but they'll do it very slowly. So you'll see that whereas the U.S. has already picked up their buyback, so you would expect to see the U.S. Really start to put the dividends back into place. So yes, it will be varied. The U.S. will probably do a little bit better in terms of year-on-year dividend growth than the rest of the world. So that's an important part of the story. I would just mention also that Q1 will still be down globally in dividends. So that's going to hurt the year-on-year comparison. So we won't see the resumption of dividend growth, we don't think, until the second quarter.
And Matt, are there sectors that you would expect to perform better or worse? For example, we know the energy sector and financial sector have been known for those higher dividend payouts. A lot of people who are looking for income, whether they're in retirement or getting towards ready to retire, those two sectors have always been relied on for dividend payouts. Is that still going to be the case?
Well, yeah, they still will be dividend payers in general, but they were the sectors you mentioned, energy, banks, some real estate, were the ones that cut the most from a sector perspective. So you'll see them start to resume those payouts and start to return capital to shareholders that way. But again, it will be slow as the economy heals. But those are the sectors to watch for sure.
All right, Matt, we appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.